Hi, welcome back. We're in our Section 3, Chapter 10, Liabilities. And again, use the table of contents to go from slide to slide. We're going to look at a bunch of journal entries, and we are issuing bonds, which brings cash into the company. We're paying interest semi-annually, and then at the end of the year, if interest is not yet due to be paid, we will accrue it. And then retiring bonds. And please follow along on your course pack. If you have not printed it out yet, do so now. Face value of the bond is what the company will pay back the bondholder. Company gets cash from the bondholder, the company pays interest to the bondholder, and when the bond is due, that is what is paid back to the bondholder. And what's more important to the bondholder during the life of the bond is that face value is what interest is calculated on. So regardless of what the bondholder paid for the bond, either premium or discount, and we're going to talk about those terms in a few minutes, interest is calculated on face value. So what does the bondholder pay for the bond? Market interest rate plays into this. And there's some pretty significant present value functions that we're not going to do in Chapter 10. We're going to pick those up in the next section. But for right now, you're going to have to take this on faith. Market interest rate is different from the contract rate. So the contract rate is locked in the contract. The company cannot change that rate once it is set. However, the market fluctuates all the time based on the economy, based on the prime rate. But bear in mind that it is the rate for investments of similar risk. So bonds can be issued at face value, which would mean at 100% of face value. So if a bond is face value, remember for these bonds the face value is always $1,000. If it's issued at face value, it's issued at $1,000. If it's issued below face value, maybe for $900, then we say that bond was issued at discount. If it's issued for more than face value, we say the bond is issued at premium. All right, so this page I'm going to ask you to follow along with as we go through these slides. So let's take a face value issuance. Willis Inc. issues a $100,000 5-year 10% bond at 100, and that's the wording, at 100. We don't say at 100%, the percentage is implied. Interest is payable semi-annually, and we record the sale as cash $100,000, bonds payable $100,000. And it's kind of funny wording. We say it was sold. We say it's a sale, even though it's a loan. It's just kind of the way that's worded for bonds. So Willis Company has just brought $100,000 into the company. Now look at the wording at the top there. 10% bonds refers to the interest rate. Interest is payable January 1st and July 1st. So that first interest payment is going to be due July 1st. And we're going to make this simple and assume no previous accrual. So 10% of $100,000 is $10,000. But it's half a year, so it's only $5,000. And there's our journal entry to show that payment. Now, pay attention here. That first item is an account number, bond interest expense. Of course, cash, you're familiar with that. If you drop the word bond from there, that's fine. You can just name that account interest expense. Bond interest expense is just a little more specific. Okay, so it's the end of the year. Company's going to be issuing financial statements. They won't, however, be paying interest until January 1st. So here they are, it's December 31st. They owe 6 months of interest minus 1 day. So they're going to accrue for that full 6 months. Bond interest expense, but now they're not using cash because they haven't paid it out yet. So it's bond interest payable or just interest payable. And remember, for exams, always put a description underneath that journal entry. Okay, so what is the total cost of borrowing? They're going to pay $5,000 out every 6 months for 5 years or 10 periods. $50,000 is what this bond cost them. Ouch. Market value of the bond. Market value is a function of three factors that determine the selling price of the bond. So as the market fluctuates, if the market is not exactly equal to the contract rate, the bond will not sell at face value. It will either sell at premium or discount. So three major factors: life of the bond, the selling price when the bond was sold, and the market rate of interest, again for investments of similar risk. Okay, you've probably heard, most of us don't know much about bonds until we take financial accounting class, but you've probably heard in the news, interest rates went down, bond prices went up. Interest rates went up, bond prices went down. So bond prices react inversely to market interest rate. So when the market rate is higher than the bond contract rate, the bond is sold for less than its face value. Now there's a calculation that we can walk through later, not in chapter 10. But let's just think this through. Your bond is selling, the company's bond is selling for and offering 10%. Let's say the market has fluctuated and the market is offering 12%. So the market bond is going to be more attractive. The company cannot change the contract rate, but they can change the selling price. So they do a calculation to match. So they have to lower their cost, their selling price of the bond. And that way the person who buys the bond will get the effective market rate of 12%. So we put that bond on discount. And I show this James Bond movie because I think this was one of the less successful James Bond movies. It didn't gross as much in the box office. Okay, so here's the journal entry for that. Willis sells 100,000 5-year 10%. Now notice those the same fact pattern as the previous journal entry, but we're not selling it for face value. We're selling it for $92,639. A little bit less. In bond speak, that would be 92.639. Okay, so when we issue this bond, we only collect $92,639. So we still owe the whole bond. You can see this below. You can see this bond payable. We still owe $100,000. We only got $92,000, so we booked the difference to this account, discount on bonds payable. That's a cost of issuing this bond at discount, but it's not an expense account. It's a contra liability account. And this is how it looks on the balance sheet. Bonds payable, $100,000. Discount on bonds payable, $7,361. Book value. So the cost of this bond was higher than the cost of the previous bond because of the discount. So you can see the principal, $100,000. That's what we're going to be paying back the bondholder. We're also paying the $50,000 in interest, just like in the last example, but we only got $92,639. So the cost of this bond is $57,361. $7,361 more, or you could take the $50,000 plus the discount. So when you issue a bond at discount, it increases your interest costs. Okay, let's look at a premium bond. This one did a lot better in the box office. Now think this through. Again, if the company's selling a bond at 10%, but let's say the market drops to 8%. Now the company's bond is more attractive. The market bonds are less attractive. So in order to adjust this bond so that it can match the market rate, the lower market rate, we charge the bondholders more. So let's take an example. Willis sells 100,000 5-year 10% bonds for $108,111, more than face value. Cash comes in higher. We still only owe the bondholder $100,000 at maturity, but we have a premium on bond payable. That's a balance sheet account. However, it does reduce your interest costs. And that's how it looks on the balance sheet. Now note in the last example we deducted the discount. In this example we add the premium. So the normal balance for premiums, as you can see in that slide, is a credit balance. The normal balance for discounts are a debit. The normal balance for bonds payable is a credit. So in this example, you have 2 credits, which increases the balance. So why aren't all bonds issued at face value? It's a timing issue. By the time the company prints the bond certificates, locks in the bond indenture, the contract, and markets the bonds, it would be virtually impossible if the market rate and the contract rate would be the same. It's kind of like when you lock in a mortgage when you buy a house. So what's the true cost for that bond at premium? Again, $100,000 paid back to the bondholders, $50,000 paid to the bondholders for interest, but we actually got more than face value. We got $108,111. So our cost of borrowing was less. So when we issue a bond at premium, it decreases your interest costs over time. Bond trading. Bonds are publicly traded on national security exchanges. You can look them up if you go into www.fidelity.com. You can look them in the newspapers. Often the link on these websites is fixed income because they have that locked-in interest rate. So you can read this. The Boeing company was issuing bonds. They're offering 5.125%. They're selling them. Let's see, they're going to mature in 2014. However, they're currently yielding 5.747. And that's that adjustment to market rate. The 5.125 is the locked-in contract rate. All right, this concludes part 3. Let's go on to part 4.